All right, Gustavo. Oh, it came in separately. Okay, that's interesting. I think your questions came in different, or it got truncated. Okay, so that's why there's two questions, but I think it's just one question. Gustavo says, I have 3 call 59 calendar spread in XOM, May 7th and 21st. Same strike, it looks like. We are in XOM, ExxonMobil, and you've got a 7th and a 21st. And we're at the 59 strike. And you did say put spread, right? I'm sorry, Gustavo. Put calendar. Yes, you did say put calendar. Okay. 59. All right, in the money 59 put, May 21st. 59. Okay, great. And today the stock price is close to my downside break even 57. Is it a good idea to adjust with a put calendar with the 56 the same expiration? This move may be to 54.40. How could I manage the volatility in this situation? Okay. We'll see if there's any more information there as well. All right, so that's what we've got. We've got a spread here. His prices, Gustavo's prices are going to be different, naturally. I'm just going to put them in right now. Let's just take it down to standard there. Short-term expiration. Okay. Let's increase this a little bit. What is the way to repair it? Well, you could, I mean, the stock's at 57.24. You could do another put spread, or you could do a calendar call spread at 57 to see which ones. Let's try the put spread there, but I want to do the call spread. So sort of creating a double calendar, not a double diagonal, because that would be different strike prices, but let's see what this just call side would do for you. If you entered it right now, how would that increase the position or the profitability on the position? Now, it does give us a little M profit and loss chart in that case. It does lower the break even more. Your numbers would be slightly different. So the choice you face here, and this is how I comment on anything when you're fixing a spread, as you heard me say for Eileen, a vertical spread, excuse me, Gustavo, or when we're looking at a spread in this situation. The first thing you have to analyze is what is your expectation? What do I mean by that? So in my position, it was entering the loss zone by adding a calendar call with the same expirations at the 57 strike, not a calendar put in this case, not to have double calendar puts, but to have a calendar call. We do sort of create that double diagonal profit and loss chart, which sort of gives us this M profit and loss chart, sort of like an iron condor. Naturally, just by looking at this position, looking at this graph, what can we say? The only reason I would do this as a repair is if I had a strong expectation that XOM was going to stay within these trading ranges, okay, that it was going to stay somewhere in this range and in this range. So the repair would make sense on the position. Okay, that's what I would look, that's why I would do it. If you're not sure, if you think XOM or the market as a whole right now is more bearish, is going to turn a direction, bullish or bearish, then you might be able just to manage the initial position. The stock has fallen to 57. I'm at a loss zone on my standard horizontal spread, same strike calendar spread. Maybe I can create a diagonal. And how would we do that? Well, we're going to sell the 59 put. I'm sorry, buy to close the closer in 59 put, and maybe roll it down to an out of the money 57. Now, this is going to increase my cost basis. I know that. This is really going to increase the cost basis from the debit I had. But in this scenario now, if it continues down, I'm in a profit level. You just took your horizontal into a diagonal where if you think that is the direction that it's going to go, Gustavo, it could help with the lower break even if that's the sentiment. Of course, you could do the reverse. You could buy this back and maybe sell a 60 put, higher strike put here to create an opposite calendar call, a bullish calendar put spread if your sentiment was the market was going to go back up. So I think you have opportunities here. You could do just the standard calendar put spread at 57, as you mentioned. I usually, if I'm looking to repair a diagonal calendar, I don't use the horizontals. I don't use the same strike spreads, Gustavo, personally. But again, if I'm looking to repair one of my diagonal calendars, I might add a calendar put to it to create that double diagonal that we saw. Looks like an iron condor, widens my break evens, still gives me an opportunity for a few more right cycles. That's a possibility you could do. You could do it with the put spread also, but you could also do it with the call spread as I showed you in that example. You have an opportunity to just roll the short call down based on sentiment. If you think it's going to go down, you can roll that short put down to a lower strike, create a diagonal from your horizontal calendar spread, and you see that you'll probably increase the break-evens to the downside, but your sentiment in this case would have to be bearish. It seems odd, and it would probably require a margin requirement because this would now look like a bull put spread. But if you bought back the 59 and rolled up to the 60 or the 61 because you were bullish on XOM and you thought it was going to continue to move up in price, I know it's been falling, but if you think it's going to change, now you sort of create a calendar spread, potential higher credit there in that case. I'm sorry, not higher credit, but a return here with a low debit because you're selling an in the money put. Now, what's the risk here? The risk is potentially early assignment, right? Because now I'm in a debit spread, essentially, but what you're in a debit still, but essentially you're in a bull put structure. You essentially have a 59 put, and you've sold a higher 60 in that case. So that runs into that same problem there where now you have to cover the margin requirement and your put is in the money in this case. So you might want to consider that, or you could always do the opposite, close the bull put and then do the bear call, or just close this bull put. I'm sorry. Close this horizontal put spread, Gustavo, and open a put spread at the 57 strike as a management technique, or maybe further structures. But I think we saw here that you could roll down the put, you could add that call calendar, you could probably add the put calendar as you mentioned to repair the position. You get an increased break even. But before managing for the sake of managing, before managing just because you see numbers here in a graph that gets you in a position, you've got to analyze the sentiment. What is your expectation of what the stock is going to do next? Okay, does this new repair graph that you're seeing match your sentiment for what you think is going to happen next? I know there's never a clear answer to that in that case. But don't repair for the sake of repairing just because something's there. If you build that double calendar we looked at, but you're not neutral in the position, you think XOM is going to fall, set yourself up into a repair that matches that structure, like the calendar put we showed by converting your horizontal to the diagonal. Gustavo, I'm sorry, you said, thanks so much, great explanation. Are you going to publish a link so I could be able to review it? All right, well, as always, what we do at the end of the webinar, when we're done the webinar, we have about 4 more questions here, 3 from Domenico, 1 from Eric, and then another question that came in. The process has to download to Gustavo. The recording has to process, lack of a better term. And then once it's processed, we'll cut the video up into segments. We'll take Eileen's segment and the question on the credit spread and debit spread repair first. Then we'll have yours probably on its own as the calendar. And we'll look at the married put approach that we just did there. And then we'll have Eric's section maybe thrown in with one of them too. I'm going to take a look at that when I really read his question, Eric's question in a moment. And then what I'll do after parsing those out and separating them and reconverting them, they'll be published to YouTube on Saturday, maybe Saturday afternoon, maybe Sunday, but I've been trying to do them on Saturday. And then we'll send an email to everyone when those are posted. Of course, as always, some of them will be posted in the webinars archive. So if we go to, here's one from 413. Here's one from 417, the 8 ways to manage a profitable long call. Last week, we had a look at the probability calculation. We had the discussion there. And then, of course, requested topics. Stops on a bought call and the top 10 highest call premiums. My apologies. Customer wanted to know how to find the top 10 highest call premiums for a covered call. We just created a search for that. So yes, Gustavo, this presentation is recorded. After I do the processing, cropping up the videos, getting them into those sections, then we'll post them and we'll send an email out when they are posted as well. Great question, Eric. Before Dom's questions, great question, Eric here. Sorry, so Eric says, how would you protect yourself when buying leaps that are no longer leaps and are now just 6-month long calls and theta's working against each and every day? Is the only solution a poor man's covered call, sell front months against it? Well, there's a lot of different ways that there's a few different ways that you could do that. That is the most obvious one, Eric. If you're worried about theta and now your leap is going into the 6 months zone there, you bought a leap a year ago. Last January, you bought a leap for Apple you'd mentioned, okay? And in this case, it's now only 6 months away. Well, okay, it was a leap Yeah, but now it's only 6 months, 7 months away. Let's just use October. That's close to 6 months away. So let's say last year bought in October. Doesn't have to be January to be a leap, but in any case, we bought a far out. It was at least 12 to 13 months out when we bought this. Now we're only 6 months to go. Now let's say we bought a 130 call and we paid $15.60 for it or so. I mean, just looking at about a 50% loss now with it down to $10.60 is roughly where we are. Okay. Now, let's see here. Okay, so this is I'm going to kind of show this here. So this is part of Dom's question here as well. So I'm just going to go to the option research. Anytime you're researching a position from the chain, from a portfolio, from a position, we can go in here into option research. And this shows us all of the Greek values. This is part of Dom's questions. I'd like to study the Greeks when I make a position. How can I do it? Well, Dom, in most cases, if you're doing a search, you can add the Greeks into the search. You link to the option research table. You have all the Greeks right here as well. Okay, so that's all shown for you. And if you're tracking a position in the portfolio, Domenico, there is a link right there to use a view in the portfolio to look at the Greeks view, which will show you the Greeks of your open positions and the total sum as well. We might take a look at that in a moment. Okay, all right. Yeah, so if you're using a position there, you can enter it in the portfolio, Domenico, and then you can see it on the Greeks there for the credit spread, and you can see the individual Greeks of each leg of the spread in here. We just don't show the ratios in the credit spread field. Okay, so Eric, we want a theta here. We have pretty small theta still for this October option. It's 0.02 or 0.03, so we're going to lose about 3 cents per day in that case. And as you mentioned, the obvious, not obvious, but the easiest way to hedge against theta decline on your longer term option is to create a calendar. Poor man's covered call, but I'm going to call it a calendar call spread. It's the reason I don't like the term poor man's covered call. And I might go 14 days out or so, and I want to give myself some room. But I go out 135. I know this is the strike price that Patrick was worried about with his Apple call because he feels it's going up in the married put. But here we get about, let's just call it 97 cents, Eric, in that case. All right. And I know this looks terrible in this case, so we wouldn't do this. I apologize, Eric. I wouldn't do this. This is not a good calendar at all, or poor man's covered call. It's not giving us as much premium in this case. It is going to hedge against theta, but the idea here is that if I'm doing it every 14 days, if I stay in this position for another 80, 90, 100 days, we can write it 7, 8, 9 times. Okay, so we can collect almost $9 in premium, $8 to $9 in premium, cutting our cost basis in half. But again, this is not a good one. I apologize. I'd probably go, let's go further. Let's go to 21st of May. And it's not that much further. But we're going to have to pull up something closer here. We're going to have to go maybe the 134. I really like the 133 at 2, but I know that's likely too close for your sentiment on the position. And why is that? It's because, let's just go 220. I'm sorry. Okay. Still not there. And that's probably, I have way too high of a price in here, but that's okay. It's already assuming a 50% loss, and that's probably why. Same situation we saw before. Excuse me. But yes, yes, Eric. This is one good way to help the theta repair. You could do a butterfly too. Another thing is you can roll further out in time. I have investors that do this. Right? I have investors both with married puts, Eric, and with calendar spread positions. And what they'll do is that they'll buy, right now, they'd be looking at 2023. They're buying today, they're buying in January or September 2023, 600, 500 days out. When this gets to within 200 days, 180 days, when it gets 6 months out, they're going to sell to close it. That they've been doing income on it the whole time. They've been generating income on it the whole time and lowering the cost basis, but they're going to just continue this trade and roll it out another 2 years at that time to 2025. It's available, or 2024. And when they get within 6 to 5 months in, they're just going to roll it out further and then continue to sell against it. Yeah, that's right. So sell to close your existing one to take the remaining time value it has, roll it further out to reduce the theta. It increases the cost basis. You're absolutely correct. And the car is coming out. Yeah, that's right. So the car is coming out as well. But again, this goes right, what your two comments on go right back to the conversation that we had before. This doesn't look attractive at all. I understand that. We tried to go to the 1 month out 133 with my price, which wasn't a real price you entered, I understand. But this is all negative. This is all negative in this case. Okay. I likely wouldn't do this, and we'd have to go further out. But again, based on the timing, we know, we're past earnings. I'm pretty sure, right? We're past the earnings date. I think we had this conversation 2 weeks ago. Yeah, so we don't have to worry about that until sometime in July in this time frame. But if your expectation is that because the car is coming out, things are going to be moving up in price, Eric, things are going to be increasing in price as well, then this might not be a good repair at this time. How do you avoid theta decay? Well, without getting into a whole discussion on delta neutral and buying 2 more calls, or let's say you have 2 calls now, so you buy another 2 calls and then you sell 4 calls, or you buy 2 more calls and then you sell 3 calls to get a ratio where you're trying to be delta neutral or theta neutral in that position. You got to remember that still changes the structure of the trade. And if it's against your sentiment of what you think is going to happen in the next 30 days, 40 days, or 50 days, that doesn't make sense. Even if you're delta neutral or you're theta neutral, it's going to hurt. And you mentioned again, you hate taking this loss. You got killed by the IV. But remember, if we're rolling out in this, the ratio, in a sense, the ratio kind of structure in that case, Eric. But again, that's going to change the dynamic of the spread. If your fear is we're seeing theta decay, you're seeing a loss in this position, and you're still bullish, though, on the position. You're just afraid that you overpaid for it. You paid into high IV. Well, a lot of things, believe me, that were bought back in September and June, of this year. You know what I mean? Last year, but bought in September and June had a high implied volatility, and that's just what we had to do. Okay, so doing the ratio spread, trying to do it in that case, remember, it's going to change the whole dynamic, and it might not match your sentiment for the position. All right. And I wouldn't suggest doing this as a 2-for-1 either, because remember, that leaves you now with a naked call. The margin requirement is going to be high, and it's still not getting you to what you need for the position. And look at that loss going forward if it keeps going up as you expect. That's where it becomes dangerous. That tip I mentioned in those other 2 discussions, about don't manage for the sake of managing. Make sure the management matches your sentiment. Okay, and that's key. And I don't want to see unnecessary risk taken in the direction of the upside just to try to get this back to break, even if it's at this one specific point on May 21st. In that case. So that's what you got to watch out for. But yes, a great way, a good way, common way to avoid theta with the leap transactions is to sell the shorter term 2-week out, maybe 3-week out calls against it, so that the decay that you're getting on the shorter term is helping with the theta decay as you get closer to that expiration in that period, Eric. And that's what we want to look for. Let's take a look here for calendar spreads. Yeah, to offset losses, but to also hedge against theta decay as well. Absolutely. Yeah, when the calls start going against us, the repairs there that we want to look for, converting it to maybe a calendar, converting it to maybe even a bearish calendar if it's actually going in the wrong direction. But remember, Eric, the one thing you also want to do, and I had mentioned this with the credit spreads, that my hard stop I do have is closing the position when it hits the 50% loss. That's really my only hard stop I have on the position. You want to have a trading plan, because there's got to be a point where you have to say, I want to get out. When is too much enough? What I wanted to mention it to you, whether I'm doing a long call, a married put, or even, let me just go to long call here. Oh, wait, I want to leave that. I'm sorry. I wanted to leave naked put there for the next question for Dom. And I'm going to take out long strangle here. I'll put in long call. And you had mentioned, Eric, a comment about the rookie mistake there. But what I want to show you is for the future, Eric, of course, when you're doing certain strategies, buying calls, screening for those positions. Remember, we did those I don't know if you saw them. We did presentations back in October where we referenced the EAP, the scary thing that was coming up in a 2-month time period where we had earnings. We were thick in the earnings season, election, and the pandemic. We called it the EAP, the three things that were causing massive implied volatility starting in August, then in September. So you're looking to buy January options then, even January 2022, but January 2021, you're looking at June options at that time. Everything was overpriced based on the markets. When I'm running a search for a married put, maybe a long call, I will use a filter for this percent implied volatility range. And when I'm buying, I'm typically looking for a ratio, an implied volatility range of less than 55. What does that mean, Eric? It means I'm telling the system to only show me options that are in the 55th percentile or lower of their total implied volatility range over the life of the option. And we've got some good numbers in here, 22%, 17%. 6% here for Facebook, 13% here for Facebook as well. And in that case, that's what I want to look for there, Eric, to filter out so I don't get trapped in a volatility crush. But again, had I run this, taken the same default search I just did and lowered my percent implied volatility range to, let's say, 35%, and I ran that back in September or October of last year, looking for options that are, 3 months to 6 months out in time, I probably would have seen no results, because they were all inflated implied volatility going further out in time based on the effects of the events coming in. But that's a great filter to use for buying positions and for married puts. So not paying too much into the high risk of the married put. I'm not playing into inflated put. I want to keep my percent IV range usually below 55 for buying and maybe above 60% when I'm looking to sell in that case.